Welcome back to Palisade Radio. I'm your host, Tom Bodrovics, and joining me today is Sven Henrich, better known as the Northman Trader. How are you today, Sven?
I'm doing well. How about yourself, Tom?
Excellent. You don't have a traditional background, like a non-Wall Street background, and I thought that was kind of interesting on where your career started, and if you could tell us a little bit about how you also got into being a technician in the charts.
Sure. Yeah. I'm actually coming from a corporate background. For a long time, I was in international corporate development in the wireless sector, actually building out wireless networks. This was back in the heyday of mobile licenses becoming available. So we trekked around the world and applied for mobile licenses and then built out these businesses when we won the licenses. So that was a completely different career path. And I ended up in trading. Obviously I had been investing into a NASDAQ bubble in 2000 as a private investor, and then of course the housing bubble in 2007, but really got into trading right after the bubble, the crash, the financial crisis. And I've been, spending quite a bit of time in Europe and based now in the UK, and been trading full time for the last, 12 years or so. And I started on Twitter just in that time frame as well in Europe, because we didn't even have CNBC or anything like that. And when I was living in Germany there for a while, so I started connecting with people via Twitter and kind of built a following over time, putting out charts and thoughts, and got more and more involved in markets. Obviously, got to realize that there's a number of different influences on charts, including obviously what's going on in the macro world, and kind of the analytical chops I developed in the corporate world has helped me in terms of coming from the corporate world. We were looking at corporations in terms of discounted cash flow models, just valuing what companies should be worth or could be worth and so forth. And that process has really helped me in analyzing charts and companies and markets, and then obviously the macro world as well. And obviously over the years, I've been looking at the macro in terms of what's happening with central banks and obviously the global economic developments. And so my approach to markets is a mix of the technicals as well as keeping an eye on what's happening on the liquidity front and how it impacts markets. And I guess over the years, I've developed a bit of a critical reputation of central banks, because I am at this point a bit flabbergasted in terms of how this has all evolved over the last 10 years. And so, that's where you hear me ranting a bit on Twitter once in a while about that.
Yeah, and I find your Twitter an invaluable resource. You've got lots of great information there, some interesting insights, a little bit of satire. And as you were talking about making connections on Twitter, you also met your wife on Twitter, correct?
That's absolutely correct. She found me. She DM'd me, was it 8 years ago, something like that, told me I was wrong about everything, and I was intrigued.
Yeah, no doubt.
Yeah, it turns out she was right about a lot of things, and she in her own right is an absolute brilliant swing chartist. And I've, over the years, just been absolutely baffled by some of her calls that have all come to fruition. So, people say don't fight the Fed. Well, don't fight my wife, because, holy crap,
And we'll get to a couple of the calls that she highlighted to you. But I think I'd like to start by raising an important point that you've made in the past here. And that's that right now we're inside of a recession, yet we've never seen the types of valuations like this. Like the market cap to GDP has never been this high. So tell us a bit more about that, please.
Well, there's a couple aspects to it. First, just to understand the historical part of it. Okay, market cap to GDP is actually a indicator that Warren Buffett has followed for many years, right? And if you get into vast extensions of the valuation of the market vis-a-vis the underlying size of the economy, you typically refer to that as a bubble. It's just some numbers in context. In the 80s and 90s, actually, or 70s, 80s, and 90s, that indicator was kind of moving around between 65 to 85%. It was not until we had the tech bubble in 2000 that we saw this massive spike higher. It came to 150% market cap to GDP, completely outside of any history that we had, and it was a classic market bubble kind of definition. Of course, then we saw the crash in tech, and we saw a recession that lasted until 2002, 2003, when the bubble became unwound. And just for reference, we went from 150% market cap to GDP to around 75%. So it was kind of cleansing of the system, if you will. And then that brought about, obviously, the housing bubble. That was when interest rates were lowered quite a bit during that time. And we had another bubble. It was obviously very specific to the housing sector, but market cap to GDP, again, moved into about 135%. And then, of course, it reverted, right? We had the great financial crisis, we had the crash, and then it bottomed into 50%. So those was big reversion and cleansing of the system. Now, what has happened since then, we've entered a new era. The era was central bank intervention. Obviously, on the heels of the great financial crisis, they dropped rates to zero. There was interventions everywhere. Central banks in Europe and other places, Japan, dropped interest rates to negative. And we had the advent of quantitative easing. And QE1 and all these interventions, and I think it's really important for people to understand how this has all morphed over the last 12, 13 years. These were supposed to be emergency measures at some point, right? They were supposed to walk them back. They were supposed to normalize. But what they came to realize, I believe central banks, or what market participants also realized, is that whenever there was any sort of trouble in the last 12 years, 2011, 2012, whenever there were sizable market corrections, central banks not only did not pull back in the interim, they started expanding. There was twist, QE2, QE3. And when the Fed was trying to reduce their balance sheet in 2018, other central banks were still printing heavily, like the ECB, and they never even managed to raise rates to zero. So we adopted all of a sudden, not we, but obviously central banks adopted a regime of permanent intervention. And how that relates to market cap to GDP, to your question, I think is really critical to understand. Because of this permanent method of intervention and aborting every market correction in the meantime, which is in essence what these interventions have produced, because investors have become used to corrections not lasting for more than a few weeks at the most. And so the system never gets to really clean itself out. So there's always the so-called central bank put there, right? And so over time, market valuations vis-a-vis the economy have steadily risen over the last 12 years to the point actually last year when the Fed stopped its program of balance sheet roll-off and actually went to a regime of rate cuts and then expanding their balance sheet via the repo crisis that they had in September. They managed to do something that we hadn't seen since the tech bubble of 2000. They managed to exacerbate market cap to GDP to 158%. Higher than the NASDAQ bubble. This was in February, and that's when COVID hit, right? And then we got the 35% crash in 4 weeks. And of course, what did central banks do? They went into intervention mode, the likes we've never seen before. What was hundreds of billions of dollars in 2009, 2011, and 12, and so forth, now has morphed into trillions of dollars in intervention, right? The Fed's balance sheet had been reduced to about $3.69 trillion last year, and now they're sitting over $7 trillion. So the amount of liquidity that has been thrown at these markets is absolutely unprecedented. And so in context, when you look at a market cap to GDP cleansing of 75% or 50% in 2000, 2007, which is what you would typically expect to see during a recession, instead what they've done here is create this massive blow-off top that we had just now in September, where market cap to GDP hit 187%. So everything is upside down. You have the largest economic crisis of our lifetime, and you have the largest market valuations in our lifetime. Something doesn't quite match up, does it?
Not at all. And something has to give there. And you were also pointing out that this is a dangerous game because now we have retail investors that are willing to chase these shares at any price, irrespective of valuation, earnings, or any traditional metric, correct?
Yeah, and see, this was the interesting part in the last few years, because even in February, there was no retail mania associated with high market valuations. The 2000 bubble had a retail mania. I mean, I remember everybody was chasing, Pets.com and whatever, Cisco and whatever other stock was out there, because that was the momentum move, right? And this is an interesting phase of psychology, because, when you have bubbles and markets completely disconnect from the fundamentals of the economy, people change their narratives because they want to justify the price action that is taking place. They want to believe, they want to think, yeah, Tesla could be worth this or Apple could be worth that. And it becomes fantastical and the momentum feeds on itself. And what's happened this year, I think, is a combination of factors. Obviously, one is the incredible Fed liquidity. Second one is that technology obviously has benefited and deserves a premium vis-a-vis other companies in this crisis as a result of working from home and all that. So there's some justification to that. But then also thirdly, you had last year, the brokerage started getting rid of commission fees, right? So it was kind of a invitation to join the fray, if you will. And obviously with people sitting at home and not having jobs and maybe even some free money, that kind of all came together to create this mania. And so we had valuations in these stocks, specifically in tech stocks, just absolutely go to the moon again. And I use Apple as an example, because it's the most successful, most valued company out there, but it's also having such a disproportionate impact along with some other key stocks on the main indices. That is a good one to take a look at, just to get a little perspective. And my perspective on this one was simply to say, look, it took Apple, which is a great company. I'm not arguing about Apple. I'm just saying, look at it from a valuation expectation perspective. It took the company 35 years to reach a $1 trillion market cap valuation. It traded at $1 trillion in 2019. And in September, at the beginning of September, it reached a valuation of 2.34 trillion. That means in 1 year, it gained more market cap than it did in the 35 years prior. There is no earnings story, even with positive expectations of 5G and so forth, that would justify that multiple expansion. And that people should be aware of that. All of these market moves we've seen in the last 2 years have been based on multiple expansion. 2019, there was no earnings growth. 2020 is negative earnings growth. Why are we thinking we deserve higher stock prices with such a performance? I ask. The fact is we don't. But this is what these just giant influx of liquidity has created. And so that was my concern as we went into late August, early September, that we're building another massive asset bubble. And some of that air has obviously come out. Now we see stocks like Apple and Tesla having corrected somewhat sizably here in September.
Absolutely, Sven. And I think another great way that you've looked at it in the past is by looking at the XVG. And it really shows a different way to kind of weight the stocks and look at the general market. So could you tell us a bit about how you use that tool to look at this?
Yeah, so for your audience, XVG is a technical measure of, it's called a value line geometric index. It's one way of measuring equal weight of stocks. If you take a basket of stocks, price everything at $100, for example, and see how they perform relative to each other, okay? And what's been striking about this indicator over the last couple of years, it actually peaked in 2018, right? We had the heels, the benefits of the tax cut that were adopted, and then we had this massive buyback run, and everything was kind of lifted up, the small caps and banks, and everything was doing well, right? But then it started diverging negatively. The equal weight component started showing weakness in the banks, in the small caps, in transports and other stocks. And so the weighting predominantly started moving into tech. And so that was a sign that something was amiss with this market. And this was before COVID. So when markets made new highs in January and in February of 2020, equal weight XVG was already markedly lower than it was in 2018. So there was already divergences building in this market. And I think the story of the banks is really important structurally anyway, but what obviously no one could see COVID coming as such a big hit. But what's interesting here is now that we've had this move in the summer, this big rally, there's two pivot points that I want to point out. One is the June rally. We got to a certain level, and then we had a quick correction. And XVG hit a much lower point vis-a-vis January, February. So this divergence that had been building since 2018 was steepening already at this point. But then the interesting aspect was when the S&P and the NASDAQ just swooped to new all-time highs here in August and September. XVG was not playing along. In fact, it made what you can call a double top vis-a-vis June. And just so people understand is what this XVG really implies. From my perspective, when I'm looking at this, if you look at the levels of XVG, What it's basically saying is that if you take the market on an equal weight basis, the S&P should be trading at 2750 to 2850. It's actually near the December 2018 lows. That's how weak it is. Okay, so there's a couple implications here. One is it just shows how exacerbated the move was due to high cap tech, the Amazons, Apples, Facebook, Google, and so forth. It shows how weak the underlying market is on a relative basis, right? And so from my perspective, this reversion that we see now in tech, if you want to see an improvement in this market, if you want to see an improvement of the larger macroeconomic structure, you would want to see a market improvement in XVG. And we haven't seen that yet to date. So what that tells me is that while we had a bubble in tech, the broader market says this is not a V-shaped recovery, that we're not anywhere near a completion of this crisis being over, and that valuations in the overall market are still too high. So that's my concern.
So one of the other indicators we can look at is the VIX. And I believe your wife, kind of tying it back to you saying earlier, she has blown you away with some of the calls that she was making. Late last year, she was calling for it to go much, much higher. And I believe you were kind of taken aback by that, correct? So could we see another major uprising in the VIX this fall? And is it all about chart patterns?
Well, it's interesting. I mean, you say I was taken aback. Actually, to my own fault, I was dismissing the call because it was so outrageous. I mean, we were last quarter, Q4 2019, the VIX was trading 11, 12, 13, 14. I mean, it was completely compressed again, and she made this outrageous call. Outrageous because it was outrageous. She called VIX 90. And, we're talking on our message board, our private Twitter feeds, and she said it's going to happen Q1 of 2020. That's the other thing. Not only did she call VIX 90, but she said it was going to happen in Q1. And it was statistically this is such an outsized call. And, excuse me for actually doubting my own wife. But then, of course, VIX hit 86 in March. I had actually put out a call in early the year of VIX 46. That was the safer call to make, and obviously that got hit, so fair enough. What the message here is, and this is not to tout our own horns, is rather to make a larger point. There's a common misconception about that you cannot chart the VIX because it's a derivative, mathematical derivative. Over the years, we've shown over and over and over and over again that the VIX actually can be charted in the form of compression patterns. And these compression patterns can take time to build. And people need to understand that the VIX can base for quite some time. But these patterns have been very clear, and I've put out a bunch of articles on this, and you can see the charts there. But when these compression patterns build, they spike out every single time. You can see it. And it's worked several times this year as well. And what's interesting to me, in addition to the compression patterns, is our VIX gaps. All VIX gaps fill at some point. And hence, I'm so far surprised when we made new all-time highs on the S&P and the NDX is that we did not fill the February open gap on the VIX. We filled it on the Dow, we filled it on the S&P, we filled it on the NASDAQ, but the VIX remains stubbornly high, did not fill the gap. Now it's actually built two more open gaps. So that's maybe a bullish argument to say when I say all VIX gaps eventually fill, we now have three open gaps. So I'm off the position that we eventually will fill these gaps. So don't get me wrong on that. But what's interesting is the VIX continues to build little bullish patterns, and it's now building a larger structure that could point to a major risk-off event into October, November. Okay, and the chart pattern there points to around 55 to 70. It's not as high as it would be in March, but it would be very sizable. And let's not forget, in 2008, the VIX spiked massively higher in 2008, and it had a lower high in 2009, but markets made a much lower low in 2009, as people recall. So don't get confused to think that, well, if you don't get to VIX 86 again, that doesn't mean the lows for the market are in it. It does not necessarily mean that. And of course, none of this is confirmed. I'm not going to say this is going to happen, but as we analyze the VIX, obviously we always look for structures, and this structure, while it's not confirmed, is not invalidated either. And for that to get invalidated, I think we need to drop sizably below 21 on the VIX.
Interesting, Sven. So I'd like to move back a little bit to the Fed and ask, in your opinion, do you think they're out of ammo? Like you were talking about when they tried to raise rates and reduce their balance sheet in 2018, we all know what that resulted in. So as we've seen them just dump liquidity into the market and rates are at all-time lows, do you think that they're out of ammo to be able to save the market if it starts to stumble again?
Well, I think there's a couple of aspects we need to look at. First, just look at the rates. In the previous two big cycles, 2000, 2007, we talked about earlier, the Fed had a lot of rate cutting ammo, right? Because we were over 500 basis points each time. And so when in 2008, and they started dropping rates to zero, that actually carried a big punch. You went from over 500 basis points to zero. That had a lot of stimulative effect. What all these central banks have failed to do in this latest business cycle, which was the longest but also the slowest in terms of recovery, is they all missed the opportunity to build up ammunition on the rate cutting front. The Fed, and when Powell came initially on board, I was all in his corner because he said, we're going to raise rates and we're going to roll off the balance sheet. I said, hey, maybe this guy's different. Maybe he's actually going to follow through. Good for him. I'm in his camp. Of course, he flip-flopped as soon as he started this first 20% market correction in Q4 2018. But the larger point I'm trying to make here is that at the end of this business cycle, all the central banks had left themselves vulnerable by not building ammunition on the rate front. The Fed barely got over 200 basis points in this cycle. So when they cut to zero this year and had started 3 rate cuts last year, they're coming from a much lower base. So I would argue with anyone and say the stimulative effect that rate cuts to zero have this time is significantly less vis-a-vis what it was in 2008 and vis-a-vis what it was in 2002 and 3. Okay, so I'm making that point saying we're coming off a much lower high. And if I extend that to other central banks, for example, the ECB under Mario Draghi, they didn't even manage to, in the longest expansion in modern history, to raise rates to zero. They stayed at negative during the entire time. And so now Lagarde went on and cut rates even further. What's the stimulative effect of that? Well, looking at the European banking sector hitting new all-time lows this week, I suggest not very much. So that's the danger, right? I mean, in terms of asset purchases, they've gone hog wild. They're financing virtually all U.S. debt these days, and they obviously have been buying corporate bonds and crossing red lines, as Jay Powell himself has admitted. But what does this actually produce when I look at the velocity of money supply? Yeah, they're one-trick pony. They think, and they will never admit this, but what they're doing is they're trying to manage the economy vis-a-vis asset prices. And I think that jig is almost up here because the only thing they can do now that they've put themselves in the corner and say we're going to keep rates at zero until 2023, the only thing they can do now is either, again, expand the asset purchase program, which is still at $120 billion a month, which is a ridiculous amount of money, or they can beg Congress to give them authorization to buy stocks directly, something that Janet Yellen in 2016 has suggested.
So as you're talking about, they're basically backed into a corner now. What happens when this market corrects? Obviously, it's never really been given the chance to properly cleanse itself because they've stepped in to avoid any possible pain every step of the way. So how much damage could be caused when this bubble actually bursts?
Well, take history as an example. Proper cleansing probably brings in below 100% of market cap to GDP. You can argue, okay, we now have companies, that have such a huge global footprint like Apple and so forth, and maybe because of these companies and their relative weighting in the indices, maybe you deserve a little higher premium to that. Fine, be generous and say 120% or 100%. Well, you still have that big gap. I mean, we came from 187 to about 170% just now here in September during this correction. So 170% is typically not a bottom, considering it had never been achieved prior to February 2020, ever in history. So we're still in la-la land, right? And what the market has again proven this year is that it just keeps chasing liquidity. And now we're entering a new phase, and this phase is incremental less liquidity, because what was brought in between March and June, that multi-trillion dollars of interventions from the monetary as well as the fiscal side is not going to be repeated. So markets now already have to deal with the irony of relative tightening. Even though they're still printing, they're now contributing incrementally less. So you now have that less liquidity. So the only thing that can happen now, between now and the end of the year, for example, is if you get another stimulus deal by Congress, which right now is somewhat questionable. And then maybe right after the election, you have another Fed meeting, and maybe Powell and his cohorts come out and again announce more purchases on the asset side. That's the only thing they got. They really don't have anything else at this point. And by the way, just to wrap this up, so it's become a confidence game for a long time. Investors are chasing the Fed, they're chasing the liquidity equation. And obviously, if they don't get it, everybody cries. I mean, this is how codependent this entire circus has become. There's not a central banker on this planet that is willing to step out and say enough. And there's not a central banker on the planet that is willing to step out and say, you know what? We are risking financial instability by creating these financial asset bubbles. None of them are willing to admit that. And on top of that, and this is probably my biggest criticism of all, Jay Powell came out this year again and insisted on saying that the Fed's policies absolutely do not contribute to wealth inequality, which is just a bold-faced lie, I have to say. Stocks are owned predominantly by the top 10%. 87% of stocks are owned by the top 10%. If you pursue policies that juice these asset prices higher, by definition, you're creating wealth inequality.
It's interesting that you bring that up, because one of the things I was thinking about as you're saying that is, do you have any ideas on how they could actually kind of solve that wealth inequality or bring it back closer between that top 10% and the rest of the population?
No, I mean, I hate to say it. I think, look, I'm not going to put the central bankers as the evil empire here. Maybe they're the clueless empire. I don't know. They are dealing with these big structural issues in the economy that the central banks have not caused, but I think they're now boxed in where they're exacerbating the problem. One of the issues we have is deflation. The technology revolution over the last 25 years has been the greatest deflationary force on the planet. So they're dealing with that aspect of it that they don't control. The other one is demographics. There's one chart I've been pointing out on Twitter every few months or so, which I think is absolutely fascinating. It shows the percentage growth rate of the working age population. And for the first time ever, it's gone negative. Okay, there's a big demographic wall that's hitting a lot of the developed world. It started obviously in Japan and Germany and so forth, but it's now starting to hit the United States as well. And so when your working age population growth goes negative and you have all these people with benefits and pensions and Social Security, Medicare and all that, you're running into a structural wall. And they've been trying to compensate over the last few years with cheap money and low rates in order to stimulate these economies. But the problem self-evidently has been that that was not enough to stimulate above par growth. The recovery the last 12, 13 years was the slowest recovery ever. It just wasn't there. And so now we're in this position where we have zero rates forever with little stimulative effect. The demographic effects are still there. And obviously the deflationary aspects from technology are still there and maybe even getting worse because they're taking on a larger part of the economy. There's no solution. And that's my worry here, because, again, the fallback solution this year was to jam up asset prices. Well, congrats. You made every tech billionaire, even richer by far, while the wealth gap in the United States has widened even. These trends have been going on for obviously years, but now it's really blown out of proportion. And so you have this really kind of sick picture of people in food lines on the one hand, and Jeff Bezos being worth over $200 billion. And I'm not saying Bezos doesn't deserve to be rich. I mean, he's built a fantastic company. I'm just saying that the market cap expansions we see in stocks that are rewarding shareholders so disproportionately vis-a-vis what's going on structurally with millions of people, I think this is not a long-term healthy basis for a solid economy. It's creating problems.
It absolutely is. One of the interesting things that you've pointed out recently is that the beginning of September is typically a top for markets. So going forward, what are some of the other possible headwinds for the markets?
Well, let me just clarify this. I'm not saying typically, but there's been a couple of periods in history where the beginning of September marked a top in markets, specifically in 1929, when you did have a massive asset bubble. And obviously, we had the 2000 crash in March, and that produced a very sizable multi-month counter rally that peaked also in September of that year. And then we had actually in mid-August, I think it was 1937, that was another one of those where markets peaked in that time frame, not in September, but in March. So what I'm saying is, in context of asset bubbles and recessions, you've had evidence of major market tops in those time frames. And let's be clear, and this was one of the questions I've been asking myself for the last few months. Literally on the day of the March lows, I put out an article called 1929 Redux, where I talked about a massive bear market rally to come to fruition. I think I called it awe-inspiring. And it's fair to say by August, in July, August, I was very much awe-inspired by what was taking place. And I'm wondering, and just tying this back to XVG, because it's obviously showing a much different picture than what the broader indices have shown. I'm wondering if we still have that potential for this all having been a bear market rally. And we'll have to see how this plays out into the U.S. election and the end of the year, obviously. But there is a chance, obviously, given what we've just seen, that maybe we've topped out for now, because to see these valuations come back in those specific tech stocks, it seems somewhat unlikely, I have to say, given the multiple expansions that we've seen. What would change my mind here is if I saw a market improvement in equal weight XVG and see some of the banks, and specifically in small caps, performing better. And frankly, what I see in banks is not particularly encouraging at this point.
Yeah, it can't really be. Could you tell us a little bit about how the dollar is gaining strength right now? We've seen it come really close to kind of breaking the chart pattern that you put out recently on one of your articles. So tell us a little bit more about where you see the dollar heading.
Well, the dollar, this dollar was kind of presumed to be dead. That was kind of the general consensus that was building through the summer, because central banks are printing. That's why obviously metals have been rising dramatically as well. And then in July, August, the dollar was doing something interesting. It started building a very clean pattern. It was typically called a falling wedge. It was a very tight channel, very precise, and it kept building that with positive divergences. And that's why I think it was beginning of September, I was on a CNBC interview and they asked me about the dollar. I said, you know what, it looks like it's breaking out here. And it did. I mean, we had during OPEX week, it was kind of doodling around, defending its little breakout that it had. But this last week, it really popped higher. And obviously, we saw the pressure along with metals. They got hit hard on that as well. And obviously, equities had suffered as well. But what the dollar has done now, it's reached a pivot zone. It reaches, well, first, a technical indicator, it's Fibonacci level. It's a 23.6 Fib, not to get too technical, but hit the 94.6 area, which also was the March low for the dollar. So I'm kind of watching this here and see, okay, are we going to see a technical rejection? If we do see a technical rejection, I think that would be in the short term positive for metals and positive also for equities again. The risk is that this pattern continues to build out, you can argue maybe a cup and handle, and then that actually any dollar weakness that we may see and any market rally that we'd see in correlation with that could end up building a larger bullish pattern for the dollar, which means a higher risk off event for stocks still to come. So none of this is set in stone. I'm just telling you what I'm currently seeing on that front. And I'm impressed, I have to say, how technically clean this has been over the last few weeks in the dollar. So very impressive. I'm curious to see how this plays out into the fall.
Absolutely. And as we've seen the dollar kind of gain strength, that inverse correlation to the metals and especially gold seems to really be intact. So you were writing that gold was kind of signaling trouble in 2019, and we basically saw it go from 1,200 to over 2,000 recently, and we've seen it drop back a little bit. So where does gold go from here, and what rebalances could we see come into gold? And I want to get your thoughts on if it could be the ultimate flight to safety.
Well, it's interesting, as you said, gold was signaling something in 2019 that put a couple of articles out, and one in the spring of 2019. We're watching an inverse pattern on gold. I think it was trading around 1250 at the time, and we had a 1520 target on it, and it played that inverse beautifully. Then it built a bull flag, and then it just kept popping higher and higher. And it reached our 2000 target, actually went even a little higher. And then I put out these market videos, and I've been talking in them about how I was getting a bit cautious about gold. We had negative divergences on these new highs, and obviously the move was very much extended, actually looked a bit like the one, in fact, the last rip this year into the 2090 area, that actually looked a lot similar to what we saw in 2011. And what happened in 2011, of course, is we had a bunch of violent back and forth, but it never reached that high again. What looks different here is this. Over between 2011 and now 2020, it's built as like this massive rounding bottom pattern, right? And so you can make a case that gold itself could build a major cup and handle. And this could take a year to build out, even maybe 2 years, I don't know. But structurally, that chart looks long-term extremely bullish. Now, what I've been saying is if you look at the move here from 2019 here to this year, if you're looking at a proper technical retrace, this thing could easily drop just from a technical perspective into the 1750 area again. Remember, there was a consolidation period early in 2020, and that could help build that handle on this cup and handle pattern, if you will. So I'm not surprised by weakness in gold. I'm not surprised that it stopped here. And I'm currently neutral on it because I don't have an edge to say, okay, we're going to rip right from here, other than maybe to say, okay, if the dollar reverses from its current technical pivot, then we can see more strength in gold again. But generally, I just want to watch this chart on a long-term basis and see if it builds that larger pattern. And if it does, then you can have a 3,000-4,000 target on gold in the long term at some point.
Excellent, Sven. As we wrap up here, do you have any other points you'd like to add?
Well, I think, look, we're dealing with a very unique situation here into year end. You can argue that this correction that we've just seen in September, was way overdue. I mean, obviously, these indices actually rallied harder than I thought. And now, obviously, that came from this massive tech bubble that we had. We just had a 10% correction, the S&P, 14, 15% on the NASDAQ, way overdue. There is a short-term potential bullish pattern that I see that could get us another rally. But I think a lot of this is now dependent on what's happening on the political front. I hate to bring in politics into markets, but we also have to be cognizant of when politics impact markets, that they do. We can't hide behind that. One of the issues right now is the stimulus package with Congress. It's kind of been talked down. I think Goldman Sachs even reduced their expectations, so it may not come to fruition. And ironically, the recent strength in the dollar may be tied to that, because the market had expected a stimulus package to come through, and to the extent that that is now being priced out, that's why maybe the dollar is strengthening. Remember, the higher the deficits go, the more pressure on your currency. So that is kind of a wild card now, given that we're so close to the election. And so you have to wait and see if they can actually still do anything. I mean, if you get a surprise stimulus package, I think markets can rip higher, at least in the short term, on that. And keep in mind, obviously, we're just down 4 weeks in a row. So there's some oversold conditions building there as well. But again, keep that in context with what the VIX is doing and the risk into the U.S. election. I think it's fair to say that we're facing a rather unique U.S. election. And I think there's concerns building that we may not have a clear winner. I don't know if we do or we don't. I don't know in which way the election is going to go. My general consensus at this point is to say if we get a clear winner and there's no contested election, no matter who wins, that there would be a relief rally. Markets hate uncertainty, and right now there's a lot of uncertainty building. If you get a contested election that's close and it ends up in courts and Supreme Court and people questioning each other's legitimacy, I think that would be a bad outcome for the country, and it's not going to be bullish for markets. And so that could actually play into that VIX pattern that I talked about. Obviously, we can't control any of that. We can just observe and see how that plays out. But that election is coming rapidly our way.
Absolutely. As you say, the markets hate that uncertainty. Sven, you have an excellent podcast called Straight Talk. I encourage everybody to go listen to it. You're available at northmantrader.com and Northman Trader on Twitter. Your website has a premium section where you give lots of great information. And is there anywhere else you'd like anybody to find you?
No, don't come to my house. I'm just kidding. No, it's all good. I mean, Twitter is where I kind of live. That's where people find me. The website is post a lot of public articles, but then of course we do our membership pieces where we analyze markets daily and risk levels and so forth. But I do put out the podcast because I think it's important to at least approach markets analytically and give a bit more in-depth vis-a-vis what you can do on TV interviews and so forth, because they're usually limited to a few minutes and so forth. And to the extent that people like listening to it, I certainly appreciate it. And I try to give my best take on things as I see it, keeping it real, as I call it.
You're great at keeping it real. Sven, thanks very, very much for your time today, and hopefully we can have you back in the future.
Thanks, Tom. Enjoyed the chat.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.